Hello and welcome to the final lesson in our 5-lesson series of 2.8 Finance, which is to evaluate the importance of the financial sector for consumers, producers and government. So as you'll see, this lies in the middle of the syllabus requirements here, but I think it's much easier to do this at the end. It also involves the most complicated questions, 6 markers on this topic. So that's why we're doing it in this order. It should be much easier to understand this section now that you have covered the previous 4 lessons on finance. So really, we can boil this topic down to 3 things, 3 main functions in terms of the importance of the financial sector. They are credit provision, liquidity provision, and risk management. So we're going to start perhaps with the easiest of these 3 aspects, which is credit provision. So we've already seen the importance of banks acting as intermediaries between savers and borrowers. So most businesses, the overwhelming majority of businesses, have borrowed money at some point. We saw that Apple started out in a garage in California in the mid-1970s and only really got going through a commercial bank loan. It wouldn't be the household name that it is today without being able to borrow money. Similarly, most households would not own their own homes unless they had taken out a mortgage, which is a loan secured on the value of their house. Most people can't buy a house in cash or with money in their bank accounts. Most will have to take out a loan. We've not said already that the government is an important borrower. So the government too borrows money. As we saw, the government borrows from the Bank of England as well as from other buyers through the bond market, which we don't really need to know about. But the government is a borrower as well. And particularly in 2020, through the coronavirus, the government is going to be spending much more money than it receives in tax revenues. It's guaranteeing much of workers' wages at the moment through various schemes. It's paying lots of grants to self-employed individuals. It's freeing up more money to allow more students to catch up from work they've missed in schools. There's an awful lot of extra money the government is spending for which it's having to borrow. It wouldn't be able to do that without the financial sector. So credit provision is a really, really important function of the financial system. It is true that some banks have behaved irresponsibly and some borrowers have behaved irresponsibly. They've taken out mortgages perhaps when they really, in their heart of hearts, knew they couldn't pay them back. Maybe the development of credit cards has encouraged more people to live beyond their means than would have been the case, for example, 50, 60 or 70 years ago. But most economists believe that the benefits of the financial sector outweigh the costs. The second one of these is liquidity provision. The definition of liquidity is how easy is it to turn something into cash. Anything that you own is an asset. So cash itself is an asset. A house is an asset. Shares that you might own in businesses are assets. And liquidity is how easy is it to turn assets into cash. Because when you want to pay for things, you need liquid assets. You may need cash or near cash. It's no good having all of your money in your house because you're not going to be able to use that to pay for goods and services or to pay your bills. So cash is the most liquid asset. Shares are reasonably liquid. You can sell them perhaps with 5 or 6 days notice. You might get the money in your account after, say, 5 or 6 days. Houses are very illiquid. It will take you a long time, 3 months on average, to sell your house and turn that asset into cash. So liquidity is how easy is it to turn your assets into cash. Banks provide liquidity in many ways. Just one of these is through an overdraft facility, which we saw a few lessons ago. So an overdraft is where you spend more money than is in your current account. So let's say you're a business and you have made some sales, but not all of your customers have paid for your goods and services yet. Then you are profitable because the customers you have made your sales. It's just they haven't paid you yet. They're going to pay you at some time in the future, but you haven't got that money yet. A bank will provide liquidity by offering you an overdraft facility. So you're a business, you still have to pay your bills, but you don't have the money yet because your customers haven't paid you. Banks will provide you with liquidity. If your customers haven't paid you, then those assets that you have are not liquid because you haven't actually received the money yet, even though you've made a sale. So banks will provide liquidity by offering overdraft facilities. That's a really important function of the financial system. The final aspect of the importance of the financial sector is risk management. So the financial system allows individuals and businesses to save their money in a number of different ways. Just some of these ways include savings accounts, shares, pensions. And what this does is allows individuals and businesses to spread their risks. So you may have heard the phrase before, not putting all of your eggs in one basket. So if you have a fund manager, what they will do is they will take savings from lots and lots of different customers and invest that money in lots and lots of different assets. Maybe they'll put them in lots of different shares. Maybe they'll put them in shares and bonds. If you as an individual want to spread your risks, you might have some of your money in a savings account. You might have some of your money in your house. You might have some of your money in shares. You might have some of your money in your pension. Both individuals and fund managers should spread their risks, not put all of their eggs in one basket. Because if you have all of your money, say, tied up in your house, and then house prices go down, then you have lost a lot of money because you haven't spread your risks. If you have all of your money in shares in a business, let's say you have all of your money in shares in British Airways, and then the coronavirus happens and airlines are grounded for months and months and months, British Airways share price goes down and you've lost a lot of money, you've lost a lot of wealth. So by spreading your risks, then you are able to insure yourself against that happening. The more you spread your risks, the more diverse your assets, then the better it is for you. And the financial system allows us to spread our risks. So hopefully that's given you just a very quick summary of the importance of the financial sector. Once you have finished those notes, you have got just one question to do on this topic, but it is really summarizing or bringing together, should I say, all of the 5 lessons that we have covered so far. So I'm going to talk you through this question a little bit, which I haven't for previous lessons because it is a slightly tough. And this is a 6 marker. So to evaluate the importance of the financial sector for consumers. So here we have a 3-paragraph suggested structure. You should explain why the financial sector is important for consumers and for which consumers in paragraph 1. In paragraph 2, you should be looking to evaluate or weigh up the importance of the financial sector. And then in paragraph 3, you can make a judgment. So in paragraph 1, you could look at the importance of either banks or building societies or insurance companies. I wouldn't necessarily look at all 3. You're going to be looking for some depth here, not breadth. So look at the importance of any of these institutions, but not both. And some suggestions for paragraph 2, the evaluation paragraph, could be the following. Well, the financial sector might be more important for some consumers than others. For whom do you think might it be either less important or more important? Who might be more affected by a change to interest rates? Who might have access to other sources of finance, perhaps, and what might these sources be? So only look at one of banks, building societies, insurance companies, and maybe only one of the suggested evaluation points. And then in paragraph 3, you need to weigh this up and come to some kind of judgment.